We can start now. Yeah, I will just say a few words as usual, and then I will turn it over to Mia. So welcome to this brainstorming session of the Friends of Multilateralism Group, FMG as we call it. We are a Geneva-based think tank focusing on the multilateral trading system and the WTO reform. Myself, I am Shenkun Lu. Friends always call me Lu. I'm the founder and also chief executive officer of the group. On behalf of our group, so let me thank you all for your participation. This is the 12th event of FMG in 2021. And also, this is the first one that is more open to other stakeholders to include a relatively bigger audience beyond ambassadors of WTO members. And also, this is going to be recorded and shared through the official website of FMG and maybe some social media too. And for your information, future FMG events will be by default open like this, unless otherwise specified. The purpose of this is, of course, to respond to requests from many stakeholders, such as international organizations, think tanks, universities from many countries that are as attached as we are to the WTO and the multilateral trading system. We do hope that through this humble means, our group, the FMG, can serve as a bridge between Geneva and the rest of the world. For those who are interested, you can find more information about our group, our activities and publications on our official website, www.fmg-geneva.org. Let me take this opportunity also on behalf of the group to thank our speakers today, James, Simon, and Zhan, and also in particularly our moderator, and also to be our new board member, Mia, who is right now in New Zealand, so quite a different time zone. This subject we're going to discuss today is, of course, a huge subject and of high importance for many people around the world. So we do look forward to a fruitful discussion. With that, I turn over to you, Mia. Thank you very much.
Thank you very much. Thank you very much, Lou, and kia ora to all. As this is the first time, as just mentioned, that I'm performing an official duty as a formal member of a group, I would like to express my profound appreciation to the members for entrusting me with my membership in the group. And I have to admit that my conviction in the advantages of multilateralism, especially in trade area, has suffered many bruises over my professional career, but those left me with actually better, deeper appreciation for political economy realism and less reliance on elegant textbook models. And so I am deeply committed to pursuit of multilateralism in practical solutions to the problems in trade. I'm very excited to moderate this session, not because of all the coffee I have taken so that I'm still awake, but because this is, as mentioned, a very important topic. We will be unpacking a direction for the future of GVCs and FDI, policy challenges beyond the pandemic. And the topic is important not only because it actually includes two huge areas, FDI and GVCs, that flirting with often on and off, but they're never really formally part of negotiations in a very sustained and systematic way. Of course, now we have negotiations on the facilitation of investment for sustainable development, but it's different from what perhaps hopes were some years back with respect to establishment of the International Organization for Investment, etc. I hope the discussions here that we will have, in addition to the analytical work that is going on with respect to collection of data and better tracking of investment, will contribute to the discussions in the negotiations as well, and maybe enlighten those with some new findings. And then with respect to GVCs, of course, the Secretariat itself has, from the time of the Made in the World initiative to the many reports that it had produced, contributed to better understanding of the dynamics, fabrics, and trends in terms of GVCs. But because of the way how the Secretariat works with the governments rather than those that are pursuing this and really making GVCs happen, again, there was not so much of a movement in that regard with respect of connecting trade policies and those that make the decisions on GVCs. So hopefully our speakers today and discussion will contribute to unpacking really what are the issues that can be added to the multilateral area of policy making. So the speakers and a discussant are of course very well known to all of you, and no special introduction would be needed from that perspective, but given the role that I have, I wouldn't be doing my job properly if not saying few words about the speakers. So let me introduce all of them now before I give them the floor. Our first speaker is Mr. James Zhan, Senior Director of the Investment and Enterprise Division at UNCTAD. But of course, most people will associate James with the role that he has in terms of being editor-in-chief for the World Investment Report and Transnational Corporations Journal. The 2021 World Investment Report has just been launched, so I'm hoping that James will be also able to give us some insights in the main findings of this report. But James, of course, has been doing much more than that work in UNCTAD only. He has been advising from academia to governments, and here today he will be presenting his recently published work in the Journal of International Business Policy under the title GVC's Transformation and the New Investment Landscape in the 2020s, Driving Forces, Directions, and Forward-Looking Research and Policy Agenda. So again, a big topic, but one that is necessary to talk about, particularly in the context of changes in GVCs, sort of, or the views on GVCs through the pandemic and protectionism. Our second speaker is Professor of International Trade and International Development and the Economic Director at St. Gallen University, Simon Evenett, and of course, long-standing ArtNet advisor. In his own words, he works on the intersection of economics, business, and public policy, and many of his publications actually fit that description. However, again, the most people will associate Simon with his work on Global Trade Alert. He was, of course, instrumental in starting that initiative, which became the leading independent monitor of commercial policy changes in the world. And I think at times, us Friends of Multilateralism might be a little bit crossed with Simon and GTA because, of course, we would like to believe that multilateralism is effective and preventing countries from falling into the abysses of protectionism, while Simon and his team have been putting report after the report showing actually that there is so much more work to do in multilateral arena to reduce the potential for discrimination in the policies. So Simon, together with Johannes Fritz, has recently put out the report. I think it was 27th report of Global Trade Alert that deals not with trade policies changes, but is looking at the FDI, and it's under the title Advancing Sustainable Development with FDI, Why Policy Must Be Reset. And so we're expecting Simon to comment on that particular report. And discussant today is Mr. Sean Doherty, the head of International Trade and Investment and a member of Executive Committee at the World Economic Forum, a Friends of a Group. And so he leads the forum's work on digital trade and e-commerce, investment, tax and competition, the Global Alliance for Trade Facilitation, and the Global Future Council on Trade and FDI. Of course, he previously led the forum's work on supply chains and transport and chemicals and mining and metals industry communities. His on-the-ground experience in express logistics and as a strategist would actually come very handy in discussing today's topic. So in terms of the housekeeping and the way how we will proceed, I'm told we will expect each speaker to speak about 15 minutes, and then we will give Sean about 10 minutes to comment. After that, we will open the floor for questions and comments from the participants. I think we would appreciate if everyone is muted during the presentations. And after that, you can use your raise hand sign. I will be monitoring the screen, hopefully well enough to recognize your indication that you would like to raise the question or make a comment. And then we will go in the order of your hand sign being shown on the screen. So with this, it's time for me to stop talking, and I'm inviting James to take the floor for his presentation for the next 15 minutes. Thank you.
Thank you very much, Mia. It's really great pleasure to see friends here from all parts of the world dealing with the trade and investment issues. This is really a great pleasure to have this gather together, and many thanks to Lou for organizing it. And thank you, Mia, for introduction. As you requested, perhaps I should start briefly with the key findings of this year's World Investment Report. So the report consists of 5 chapters. First chapter is global trends. The second is regional trends. The third chapter discuss the policy developments that includes also investment in health, the policy implications, as well as tracing the latest developments at the international investment treaty making space. And then chapter 4 is usually the theme chapter, and this year the theme is invest in sustainable recovery. And the 5th chapter is chapter that requested by the UN General Assembly to look into the sustainable finance and capital markets. So these are the 5 chapters for this year. First, about this global investment trends. As you all know, that the pandemic is a triple shock of supply, demand, and policy, and that has a severe impact on international investment, global value chains. As a result, global FDI flows fell by over 1/3 in 2020, as from $1.5 trillion to $1 trillion. And that is the lowest since 2005, and was almost 20% lower than the 2009-12 after the global financial crisis. So that's the impact on global FDI flows. And then the prospects, in a sense, we see that global GDP is projected to grow this year and close to full recovery of the pre-crisis level. And also the prediction from WTO is the trade is expected to be fully recovered by the end of this year. But that's not the case for FDI. So in fact, the fall of FDI was significantly sharper than the drop of global GDP and the trade. And the pace of global FDI recovery will be slower than that of the global GDP and the trade. So I would call it kind of U-shaped recovery as compared with V-shaped recovery of GDP and trade. For the prospects, I would say that I'm cautiously optimistic about the global FDI prospects for 2020 and optimistic for 2022. So the flows will bottom out in 2021, that's this year, and with modest increase, perhaps up to 15%, that regain part of the losses of 2020. But then the growth will gain momentum in 2022. We foresee a kind of further increase of 20 to 30%. That will pretty much recover to the level of 2019. That is $1.5 trillion. So it takes 2 years instead of 1 year to get there. But the prospects are highly uncertain. It all depends on risk factors. I don't have to elaborate, you all know. So how FDI will recover, and basically it will be led by the resilience-driven restructuring or the replenishment of capital stock at this stage, and we don't see much of greenfield investment happening this year, but momentum will be for next year. And in terms of region, and advanced countries will lead the recovery as it suffered significantly last year. For example, EU suffered 75% of decline. US suffered from kind of 40% of decline. So they couldn't be lower. So there will be kind of recovery they lead, and developing countries trail that. And particularly Latin America, Caribbean, and Africa will lag, will be lagging in this recovery. So that's the rough idea of FDI. Interestingly, during this global financial crisis, during this this pandemic, the crisis, the FDI declined significantly. But if we look at the sustainable financing, it increased significantly. I'm talking about sustainable themed funds and bonds. We calculated about sustainability themed funds, meaning the contribution investing in sustainable development sectors. This is different from the kind of ESG type of investment funds that only have a kind of due diligence in their investment. But for that fund, it reached $3.2 trillion, and with $1.7 trillion of funds, that is mutual funds and ESG ETFs, and also bonds is $1.5 trillion, green bonds, social bonds, and mixed sustainability funds. So that's the contrast. There are a lot of story behind that. I don't have the time to talk about that. But overall, we see that on the one hand, there's a lack of funds for developing countries. On the other hand, it's a lot of funds, and the growth of sustainable finance was 80% in 2020. That's a huge increase. Now let me move quickly to the theme of today that I wish to talk about. That is the transformation of global value chain beyond the pandemic. I would say, in the 2020s leading up to 2030. That's a longer term horizon. I would say that driven by five mega forces, the global value chain are under a kind of undergoing a kind of drastic transformation, and this will reshape the global investment landscape in the decade ahead. It will present the daunting challenges and opportunities for firms and the state alike, leading to a kind of strategic shift in promoting investment for development. So first, if we look at the past decade, a decade before the pandemic, and 3 decades, not 1 decade, 3 decades, we'll see the global value chain witnessed 2 decades of rapid growth, followed by 1 of stagnation. So during the 10 years before, immediately before the pandemic, cross-border investment in fiscal productive assets stopped growing, and the growth of trade slowed down, as you know, and the GVC trade we calculate also declined. So I have a graph to show with a lot of data on that. So in fact, the past few years were quiet before the storm, I have to say. So the crisis caused by the COVID-19 pandemic arrived on top of existing driving forces that I identified. And these challenges were already reaching a kind of inflection point. And the pandemic simply sets to tip the scale. So the decade towards 2030, I would say, will be kind of a decade of transformation for international production. There are 5 driving forces I just wish to highlight it. The first, the economic governance realignment. This is ongoing. I think it's going even bigger. The international trade investment policy making is shifting really away from multilateralism. That's the reality. That's towards regional and bilateral solutions. And with intensified protectionism worldwide, this make in my own country, it becomes a kind of policy trend now. So the fierce competition in trade investment technology that may lead to a kind of global systemic divide in economic governance, particularly in the current escalation of geopolitics. The second driving force is also known as the new industrial revolution. The robotics-enabled automation, enhanced the supply chain digitalization, Internet of Things, and additive manufacturing will stimulate new cross-border investment in new business sectors and through new modes of operations. I will explain on that. And the third is the kind of a sustainability imperative. As markets and governments are driving for mainstream sustainability in products and processes of the value chain, and sustainable development goals is also kind of changing the future patterns of global FDI, and particularly in terms of the source of financing, sector distribution, and geographical location. The fourth driving force is a global, this is corporate accountability. So the global efforts fighting corruptions, illicit payments, tax evasions, anti-competitive practices, all these as you feel, and also this ESG, environmental, social, and governance issues will fundamentally change the modes of operation and the governance of multinationals in their international operations, I would say. The fifth one is the recent one, that is the resilience-oriented restructuring. This massive pandemic disruption and aggravated geopolitical rivalry, and they will all drive the multinationals to diversify or reshoring or nearshoring of their GVCs, and to be more shock resistance and resilience on foreign, less reliance on foreign sources. So the combination of these 5 megatrends will drive GVC transformation in the decade ahead, and it's a combination. So I've identified 10 future directions of global value chains. 5 related to the value chain, 5 related to the pattern of global investment and the investment related trade. The first one related to the value chain is a shift of value chain from global to regional and the sub-regional levels. The second is the manufacturing, shorter and the less fragmented value chain and the more concentrated value added. This is the reversal of the trends we witnessed over the past 3 decades. And the third one is that more platform-driven value chain governance with foreign assets light business models for cross-border operations and M&As. I have a lot of data behind this to show that this all the trends I'm now highlighting. I don't have the time to show the data. Now the fourth is in services. So there will be continued growth and fragmentation in services value chain. I think Richard Baldwin has elaborated on that in his book, leading to, and this such kind of further fragmentation will lead to more service FDI via offshoring of white-collar services particular, and then servicification kicks in a big way, I will see in the next, in the coming decade. The fifth driving trend is that the GVC diversification driven by resilience building and the national security concerns that will result in more redundancy in multiple locations. Now, what are these these trends imply for FDI and FDI related trade? So the first two trends will be kind of downward pressure on global efficiency-seeking FDI in favor of regional market-seeking FDI. The second is kind of downward pressure on global trade of intermediate goods of GVCs, but less on trade in final products. The third is a shift from mass production and the economies of scale to mass customization enabled by smaller scale distribution manufacturing, in particular through 3D printing, additive manufacturing. And that's what I call it, from economy of scale to economy of scope. That's kind of shift is going to happen in a big way. The fourth shift is the shift of from GVC-driven FDI to more infrastructure-driven and domestic services-oriented FDI, particularly due to the digitalization. And the fifth kind of direction for global FDI is that the boost of FDI in green and blue economies by the sustainability imperative and global drive for achieving SDGs. So these are 5 mega trends I would see for GVC and 5 for FDI and FDI related trade. So the degree and the types of transformation will vary from industry to industry. In our previous World Investment Report, we classified industries by their intensity of GVCs and to see how that affects GVC transformation affect the different industries. You may wish to read our report, World Investment Report last year. I elaborate a bit. Policy implications, there are 5 major driving forces that I see highlighted already, and then there are challenges and opportunities. The challenges, like 4, that is increased divestment, relocation, and the investment diversion imply tougher competition for FDI, particularly due to the shrinking pool of efficiency-seeking FDI. The second challenge will be kind of value capture in GVC development paths based on vertical specialization. That's by many developing countries that will become more and more difficult. The third thing is the industrial infrastructure that built over the decades for the GVC worldwide will see kind of diminishing returns. And the fourth implication challenge is that the changes in location determinants of investment will negatively affect the chances of developing countries to attract M&A operations. So it's more difficult now. Now, there are also opportunities. I identified 5. One is attracting investors looking for diversified supply bases and building redundancies and resilience. The second is the pool of regional market-seeking investment will increase. That creates opportunities for more countries on different continents instead of focusing on East Asia and Southeast Asia. The third is the shorter value chain will bring more investment in distributed manufacturing and final goods product or production with broader industrial capacity developing for building and clustering. So clustering, I think, is getting more important than value chain verticalization and focusing on specific segment of value chain, trying to build competitive advantage on that. That has been the model for many developing countries and some advanced countries. The fourth opportunity is the digital infrastructure and platforms that will enable new applications and services to improve the bottom-up access to GVCs. And the fifth is the growing opportunities in attracting investment in green and blue economies, as well as sustainable financing. As I just mentioned, that the impact investment is rising and it's really growing big and growing very fast. So there's a need for paradigm shift of the new development path. I think my time is up. So I just escaped this part. There are three shifts. I'll just go quickly. First, that there's a need of shift from the focus on attracting efficiency-seeking investment in the narrowly specialized GVC segments to a broader export-led strategy, which extends to investment in production for regional markets and sub-regional industrial clustering. And the second shift should be a kind of a shift from cost-based competition for single location investors to competition for diversified investments based on flexibility and resilience. And the third shift is implication for policies is a shifting from general approach to all investment promotion to SDG targeting approach to green and blue economies, as well as sustainable infrastructure and public services and targeting the impact investment. So I just stop here. I think just to save the time for discussion. You may wish to read my article for policy questions. I have 30+ questions relating to big pictures. I think these are thought-provoking for us to think what will be the next for policymakers for the coming decade. Thank you.
Thank you very much, James. I think there will be quite a few questions back to you with respect to further elaborations on the policy, especially with respect to how trade policy can impact some of these targeting, etc. But let us move now to Simon for his presentation, for his talk. And Simon, floor is yours.
Thank you, Mia, and thank you to the organizers for the opportunity to present the results of the 27th Global Trade Alert Report. And thank you also for mentioning that it's co-authored with my colleague, Johannes Fritz. I'm going to raise some slides because I'm going to show you some data, and hopefully a chart is worth 1,000 words. So I hope you can see my slides now. I've given the punchline away in the title. I believe that that I can make the case that FDI is in big trouble, and I also want to make a subsidiary case that we have freighted FDI with a lot of social obligations in the last few years, ever since the Sustainable Development Goals were adopted by governments. And I think an implication of the results I'm showing you is to raise the question as to whether or not we need to rethink what expectations we're setting for international business, because they may not have the resources or they may not be able to create the resources from international operations that some people expect. There are 3 points of context which I would like to highlight before showing you the results. The first point of context is on this slide, and that is, for the longest time, globalization, ever since the Berlin Wall fell. Now, as you know, professors are famous for disagreeing, but I think pretty much agree that there are different positive benefits to FDI. They may show up in different places and to different degrees, but the policy recommendation to free up foreign investment, or free up options, or create options for foreign investment, I think is one which is very well supported, both in academia and also, more importantly, perhaps, by the international institutions. So we've had a long-standing sort of consensus that FDI is, by and large, a good thing, and that it should be encouraged. Now, the nature of FDI is that as FDI flows into host countries, it builds up a stock of capital, but we have to remember that that stock of capital depreciates over time. And that's an important point, because it suggests that the inflows of FDI every year have to maintain a certain level just to keep the current stock of FDI at its present level. So we need to almost run in order to stand still in terms of the global footprint of international business. To put some numbers on this, again, using James's work here, the estimate of the total amount of FDI in emerging markets is around $11.5 trillion. We know from the Penn World tables of macroeconomic data that in emerging markets, capital depreciates around 4% a year. So what that means is we need FDI inflows into emerging markets of at least $450 billion every year in order to replace the capital that depreciates. So put that differently, we need more than 450 billion every year if the global footprint of global business in emerging markets is to grow. And that then begs the question, are companies prepared to put that type of money on the table? And that, in my view, depends in part on what they believe the expected returns will be, which will be an important part of the story I will develop. So the first point of context is that we have to, if we're interested in FDI in emerging markets, we have to realize that there needs to be a constant flow of it in order to replenish the capital that's depreciating. And that raises the case, what's the commercial context or commercial case for it? The second point of context is that for a long time now, there have been growing expectations on what international business should be doing in terms of its operations in overseas markets and how it conducts their supply chains. And in 2015, one variant of these social expectations were built into the Sustainable Development Goals. And at that time, governments made it clear that they had neither the financing nor the capability to be able to execute the Sustainable Development Goals on their own. And they wanted the private sector to make a contribution. And this in turn begs the question, is there a commercial case for doing so? And I will speak to that with one of the slides. The third point of context is to remind you here that FDI and trade in goods are quite different. And indeed, I'm going to show you data which suggests that FDI is in trouble. But the latest data, by the way, on trade volumes suggests that actually, if you get outside of Africa and the Middle East, in the first 3 months of this year, trade volumes in every other emerging market region are actually growing around 6%. So we actually have quite a healthy trade volume response, but not an FDI response. So the two do not necessarily go together. And I believe James implied as much as well. So these are the points of departure for our study. The first set of evidence we put together really was to look over the longer term since the 1990s at the inflows of FDI, and we wanted to benchmark it against other metrics. And so you might ask the question: does FDI grow faster than world trade? Does FDI grow faster than world GDP? Does FDI grow faster than total investments? Because remember, FDI is a form of investment. The answer to all of those questions from 2005 onwards is no. So FDI is growing slower than those three variables. Now that's important because since the global financial crisis, we know that the rate of growth of world trade slowed down vis-a-vis world GDP, but this chart implies here that FDI inflows have slowed down vis-a-vis even world trade. So we have essentially some indication of FDI being in potential trouble, or to put it differently, the private sector not using this option as much as they have done so in the past. And that then sort of begs the question, why? Well, we dug into that in the following way. We looked at the returns on FDI in emerging markets, and we did this in two ways. You can look at this problem through balance of payments data, which is how it's done at UNCTAD, and you can see in the emerging markets outside of the transition economies a fall in returns over the past decade. The other way to look at this at an even more granular level is to use financial statement data, which is collected by the US Department of Commerce for American multinational enterprises operations abroad. And that's exactly what this data is what we used. And we looked at the average rate of return of FDI in each emerging market region. And we compared it to the average rate of return of FDI by US firms in the European Union. And since there is a general expectation that investing in emerging markets is more risky than investing in mature markets like the EU, you would expect to see the average returns in emerging markets to be higher. And what we have found is quite surprising results. If you look at the Asia-Pacific region outside of Japan, and if you look at Southern and Central America, for much of the last decade, there has been no premium at all in terms of FDI returns over what could be earned by American companies in the European Union. So there's no reward for taking on that extra risk. And this must beg the question about commercial viability. Furthermore, you can see from 2015 onwards that the premium on returns in African FDI, or FDI in Africa by American firms, has disappeared as well. And so what we have is several regions of the world economy where American multinationals are unable to earn higher returns than what they earn in the European Union. In the case of the Middle East and we do see falling returns, and it's interesting that the returns on investments in that part of the world are highly correlated with the oil price. So I think there's a pretty good explanation for what's going on there. So the overall picture I want to put to you, or the point I want to put to you, is that FDI is returning less in terms of profits and the like for companies which are engaged in it. Now, this finding is one which I think surprised us, and it goes against the reaction that we've had in a number of webinars where people have said to us, but our assumption was that American multinationals and multinationals in general make lots of money in emerging markets. Well, when you say, well, compared to what, and when you benchmark the profits of multinationals to the amount of capital they tie up in different businesses, we find that there are reasons for doubting that, especially since 2015, which of course overlaps with the period when the Sustainable Development Goals were adopted. Now, we also recalculated these numbers for China. There was a lot of interest in the report in terms of FDI returns in China, the argument being that they were different. And there is an interesting pattern here which we show, and that is that the FDI returns worldwide certainly rise and fall in the way that I had described earlier. In China, the premium returns which are earned were substantial before the global financial crisis and have narrowed since. So the general story of either a falling or elimination in the premium, in this case the falling of the premium, carries over to China as well. So China, returns there are higher, so the premium is positive, but it's getting smaller over time as well. So that, I think, is consistent with the broad story that we were telling. Now, if you then look at SDG sensitive sectors, the results are even more alarming. And so here what one can do is, using the same US FDI source from the Department of Commerce, looking at the years from 2015 to 18, and we stop in 2018 because that's when the Department of Commerce's latest data release refers to, we can see what the FDI is the returns on FDI are across different sectors, and some of them are more SDG sensitive than others. So sectors like manufacturing, which are very good at generating jobs and income, pay quite healthy returns. But if you go to healthcare, the return on investing in healthcare by US multinationals is about 1%, which means that in order to pay back the investment, they need 80 to 90 years, which is implausibly long. Okay? If you go to education, educational services earn 2.5% in terms of returns, and this is well below the cost of capital for many companies as well. And so we can see here a pattern of results. I suppose some people who like the SDGs would be quite happy that mining and oil and gas extraction earn so little returns as well. But these are findings which must also be taken into account, along with some of the more SDG sensitive findings. So given these low levels of return in these sectors, one has to ask the question, what's the private sector incentive to invest in them? And if there's any disappointment amongst UN officials and government agencies and the like about the private sector's commitment to the SDGs, then this chart here might help explain why they're reluctant to pour money into health, education, sectors like this, and telecommunications. And so we emphasize the returns in our report because it speaks to the commercial viability of FDI. Well, having established that, we then began to ask the question, well, do we see trends in policy change which tie up with the deteriorating returns? And interestingly here, I mean, here we tap into the Global Trade Alert database, and we extracted information about policies changes which affect the pre-establishment and post-establishment of multinational enterprises. We also looked into the resort to localization policies, local content policies. We also looked into policies which would induce tariff jumping FDI or diminish the incentive to do that. And for all nations, the G20 group, the non-G20 group, and the LDCs, we calculated in each year the percentage or the proportion of policy changes that were conducive to more cross-border FDI. And we find that from 2014 onwards, we see a clear reduction in the proportion of policies which are pro-FDI. And this, of course, lines up nicely with the falling off in the FDI inflows that we highlighted earlier, and of course, the falling returns as well. And so there is an association that's there. Our assessment is a little bit different from UNCTAD's because I think we look at a wider range of policies, but I'm sure James and I can get into that if necessary. So overall, we think policy is turning against FDI inflows. Now, I don't want to argue that countries are cutting themselves off from FDI. If anything, this is a little bit like death by a thousand cuts with lots of different interventions which are eating away at the profitability of FDI without anyone turning their back on FDI completely. The pattern that I showed you is actually worse when you compare the sectors. The good sectors tend to see more FDI supportive policies, but even there the proportion is falling over time, and the service sectors see lower proportions of FDI supportive policies. This is problematic because as our economies grow, more and more of our spending power is shifting from the goods sectors to the services sectors. So the overall policy stance may be becoming less conducive to FDI, and that we find all the way through the period. So this is reinforces our concern as well. A slightly more recent phenomenon has been the revival of interest and strengthening of FDI screening mechanisms. Ostensibly, this has had a geopolitical driver to it, with concerns about Chinese acquisitions of assets and Chinese investments in places which are sensitive from a national security point of view. But many countries have implemented FDI screening mechanisms which do not target China. They relate to all inward FDI. And there's some growing concerns that these screening mechanisms, unless they are implemented in a very efficient and effective way, are having a chilling effect on inward FDI from origins other than China. And so there's a concern here that this is adding to the burdens faced by international business. So the story so far then is that FDI inflows in retreat. They're not catching it. They're not matching the growth of world trade, world GDP and world investment. We dug into why that might be. We showed that there was a falling commercial incentive to engage in FDI, and at the same time that this is all happening, policy is moving in a direction which is not conducive to FDI. And so we link those three in a story that we tell in the report. What to do about this? I think there are three things to do and one thing not to do. Let's put on the table the thing not to do. We should not be raising trade barriers to artificially boost FDI returns. This would be a step backwards. We would essentially be sacrificing the interests of importers and consumers and customers in order to reward FDI. That's not good public policy. What we should be doing instead are three things. First, we should be giving much more attention to the commercial viability of FDI, and the commercial returns on FDI should be a KPI that is measured and managed, and we should be taking the policy support and advice and asking the question, not just how do we improve the business climate in a country or the investment climate, but we should also be tracking whether or not those reforms actually translate into higher levels of return on FDI. Secondly, to the extent that governments financially support FDI, especially as it relates to the SDGs, then that should be targeted. The host country should designate what their SDG sensitive sectors are, and then the financial support should target those, and this should apply to both support for inward FDI as well as outward FDI, and more governments are engaging in financial support for outward FDI. There is, and I acknowledge, a debate as to whether or not there should be any type of financial incentives for FDI, but our recommendation here is that if there is going to be support for FDI, and if we want to take the SDGs seriously, then we can target any support accordingly. The third thing to do is, and we show in the report, growing levels of exposure of foreign firms to economic policy uncertainty. One source of that policy uncertainty, of course, is FDI screening policies, which are not well designed and executed. And we think that a general recommendation is to find ways to try and de-risk FDI, which would imply reviewing the sort of regulatory momentum and build-up we've seen of recent years in many sectors, and also to review the application of these investment screening policies to see if they can be more tightly defined and executed. So these are three recommendations which we hope will go some way to restore the commercial viability of FDI, which in practical terms means increasing the risk-adjusted rate of return of FDI. And without doing that, we don't see how FDI will revive unless there's dramatic changes in business models, and we cannot discount that. After all, an implication of much of what James was talking about was changes in business models, which he sees going forward. Thank you very much.
Thank you, Simon, for presenting this report, and thank you for very clearly formulating what not to do, because that is often missing from the policy recommendations that at least international organizations give to policymakers. But anyway, we'll have time to go back to that after Sean gives us his comments on these two reports, or two presentations. Sorry.
Thank you, Mia, and hello, everybody. And thank you, Simon. Thank you, James. It's a bit daunting to try and comment at all after those two excellent presentations. So what I'll do is I'll just try and share a couple of observations, a couple of questions, and hopefully that will spark more from others. I must say I was tempted to just read out the questions from the end of James's paper, which are excellent questions indeed, but I'll try and bring in a couple of my own. So I think you've laid out a very compelling set of storylines here, which are easy to understand. So FDI is down significantly. This is a continuation of a trend, though it's been exacerbated by COVID. Policy is an important driver of this fall by cutting the returns. There are other factors at play here, including technology. FDI is important for development, but it's not, of course, an end in itself. Indeed, sometimes it may actually be an indicator of a lack of trade openness. And finally, sometimes looking beyond the economics, FDI may provide geopolitical levers, which may be of interest. So I think I have probably 10 observations or questions to bring in. So the first one is that I think we could say that you both focused mainly on the supply story. And I wonder whether maybe there's a little bit more that could be said from the demand perspective. So looking at the relatively high growth in purchasing power, which we've seen in developing countries, and whether the demand therefore for local production is simply outpacing FDI to a certain extent. Then a second question, somewhat related, is looking at the sources of finance. And is it perhaps the case that we have a much greater availability of local capital, whether that's local banks, local securities markets, and therefore the need for FDI is somewhat reduced? Thirdly, perhaps, James, you pointed out that the factor cost differentials are smaller, and so we expect to see less efficiency-seeking FDI. And, as Simon alluded to, presumably this may imply that erecting trade barriers to attract market-seeking FDI therefore becomes relatively more attractive, even though, of course, it may still be a bad idea in absolute terms. A fourth point, again, James, you highlighted something which is of course obvious, but I sort of missed it, which is that we should expect less trade in intermediate goods and with more concentrated value-added manufacturing. I think perhaps some of the references you made in your paper to 3D printing, from what we're hearing, might be a little bit premature. 3D printing has taken some time to really have a wide-scale effects. But I think the general point, of course, about advanced manufacturing does hold. Indeed, anecdotally, we're hearing quite a lot that advanced manufacturing is now allowing for micro investments. And so where previously an MNC might be sinking tens or hundreds of millions into a new plant, now they're able to add smaller specialized plants for just a few million. And so intuitively, that might suggest that we would see more dispersed investment. And I also wonder whether the higher concentration in value adding that we're seeing at the hub may be a little bit of a temporary phenomenon, and whether ultimately that itself may become a little bit more fragmented as we see more trade in intermediate services, such as design and other services. And move on to my fifth point, which is, I'd say clearly one of the common views is that foreign investment brings additional business with it to local suppliers, and so it has value above itself. And I wonder whether with the digitalization that we're seeing, that some of that business may now be able to be captured even if the lead business remains abroad. And so perhaps the multiplier effect of FDI could diminish in the future. Sixthly, James, I think you mentioned again, the form of the business relationship is changing. And I think this non-equity mode is a very significant transformation indeed. And we've been looking into the growth in HR tech, for example. Simon, you and I discussed this at dinner last night, services which allow companies to manage a workforce around the world without actually having a permanent establishment. And some jurisdictions, of course, as you pointed out, look through this, and so they can determine who the ultimate employer is, but many don't. And so perhaps there's some form of stealth investment happening. And so countries may be able to still play a role in GVCs without the formal FDI step happening. And I turn to my seventh point, which is more of a question as to whether either of you have a view on the corporate tax reforms which are being discussed and what their likely effect may be on countries' investment attractiveness, or whether they will at least be changing some of the investment data, and whether it may become perhaps easier to read and more aligned with the kind of realities of investment rather than more artificial investment flows or financial flows, sorry. My eighth question would be on investment screening. You talk, James, and I think maybe Simon, in your papers of the concern about fire sales, which various countries have. And I always found it a little bit depressing that this fire sale concern is mainly linked to foreign buyers. Whereas I'd have thought that, if as a regulator you want to avoid emergency cut price sales, then, the nationality of the buyer isn't really the first concern. And in relation to that, of course, there's some interesting conversations going on about whether the screening should be on the nationality of the buyer or the ownership of the buyer, or more the behavior of the buyer. So does it matter, for example, if the Norwegian sovereign wealth fund is the owner of your transport system, or are countries really more, is this a China story that countries are concerned about? Next point is the businesses which we work with tend to be very concerned about investment facilitation. And so really the issues to do with administration and red tape. And interestingly, one of the topics they've been bucketing in this more recently is to do with currency exchange. And that's something that we found a little bit hard to explain. And so I don't know whether you've come across this and have any thoughts on that. And then my 10th and final point in this sort of rapid fire list is very specifically to you, Simon, on this point that the returns on health and education investment are so low. And I wondered whether you have a little bit more color on that as to why that is. And, are there some specific services restrictions which are driving this? But again, thank you both for tremendously interesting papers, and hopefully some of these thoughts will spark further questions from others. Thanks.
Thank you, Sean. This is really a tour de force list of comments and questions, and I'm actually glad that some of these that I had previously exchanged with Simon actually fit into your list as well. So so that's great. I think maybe I should give 3 minutes to each speaker to just quickly respond to some of these, and then see whether there are questions lining up. I don't have anything in the chat, and I'm just now trying to figure out whether really the facility of raised hands is working here or not, because I'm not seeing any that can be used. So it seems that we don't have that particular function available. So you will have to wave or indicate. Oh, it does work. So Alan is already raising his hand. Any first quick responses, James and Simon, to what Sean was saying, please?
Thank you. Thank you very much, Mia. Sean, you have raised so many sharp questions. I thought Mia would encourage participants to stay in the evening to get the answer, satisfactory answer. I would do bottom-up approach, starting with the last question going onward. So, so quickly, Sean, the investment facilitation discussion on this facilitation of currency exchanges. I'm not in the context of that discussion, so I don't know what's the background. But in terms of good practices of government facilitating exchanges, that in the past there was the success story of currency swap or exchange swap in countries that lack of foreign exchanges, particularly countries like Ethiopia, for example. It still has that problem because it's kind of a planned economy, there's a lack of foreign exchanges. So it's kind of a foreign exchange swap between the foreign affiliates in the country, those market seeking vis-a-vis efficiency seeking. That's one way. If that's the case, I think government plays a role because it's a kind of foreign exchange control in the country very tightly. Country like that. Back in the 80s, China did that when it had the problem to solve the currency, the foreign exchange thing. Now, regarding the screening, I think Simon, I don't agree with you. I agree with you 100% that we need to go deeper in analyzing the impact of protectionism in FDI. In terms of screening, indeed, we saw last year there were kind of 15 countries that have put in place screening mechanism or tightening up, expanding the scope, or simply introducing new ones. It looks like a small number, but if you add their FDI stock, inflow FDI stock and inflows, it counts for over 70% of the global FDI flows. So that's the magnitude of impact. But the nuance is that some countries say that, look, we do it in the short term, we'll phase it out after the pandemic. So that's, they said it's the concern Sean rightly pointed out, saying the fire sales. Fire sales did not happen, nor did the screening impact. We document the number. The largest deals above $50 million of deals that really screened out is much less than the previous year, than 2019, which accounted for a cumulative amount of 10% of global FDI flows. Last year is much less. So we thought, what happened? And in fact, one of the things is the chilling effects, because when the screening mechanism is putting in, companies will not get into that areas as no. I think Simon mentioned the word already, chilling effect. Now the things that I would say, there's one thing that we need to look at merger and acquisition in a kind of more balanced way. At a time when assets in stress, they need buyers, they need takers. Otherwise, they go for bankrupt. Going for bankrupt is not good for the host country, nor for the people, for the jobs. So you need the takers. If there's only 2 or 3 buyers, and then there's no bargain. It's no bargain, you sell it even cheaper. So you need this bargain, and sometimes the foreign acquisition is capacity saver. That's what I say. So that's about that. Now come to the tax. The impact of tax is a big story on that. You mentioned on data. Data-wise, I would say at this stage, SPEs, FDI going through SPEs is about roughly close to 30%. It's 25 to 30%, I would say. The way we looked into the situation, into the kind of flows, is getting into the ultimate owners and look at the transit FDI through SPEs, and then we get that number. That was already back in 2015 when there was the BEPS. We looked into that. Now the issue is beyond that, of course. I think Simon mentioned about this profitability and for multinational companies. I put that aside. We did a kind of assessment. What is the contribution of, what is the tax avoidance, the absolute value, and what is the kind of a multinational's contribution? Our numbers for developing countries was basically annually multinational companies contribute roughly $700 billion of tax. I'm talking about out of the FDI stock, not flow numbers. And out of that, of course, we roughly estimated there could be $100 billion of tax avoidance. That gives you the magnitude, the numbers, so to speak, on that. Of course, there are 2 types of tax avoidance. One is through transfer pricing, the other is investment mapping. And what I'm talking about is the number of investment mapping, not transfer pricing aspect. That's OECD is good at. We help OECD with investment mapping part of the calculation and the ways and the means putting in the rules for the BEPS 1. This is the thing. But also for tax, I would say that there's one important message I've been talking about all the time, is that tax reforms has to be hands in hand with investment regime reforms and with trade reforms, because they are really closely interrelated. And that's this connection has been there. I've been attending quite a number of global tax conferences. And I do feel when I sit there speaking about from the investment perspective, I look like a strange animal. And what they are talking about is totally different from what we are talking about. That's the thing. The other is that while trying to get rid of this kind of tax avoidance through this investment mapping and through SPEs, we have to recognize the basic functions of SPEs. They have a good ones. It's a business hub for remote services to ensure that transactions and FDI flows are smooth. So that's why we cannot just while trying to control this, how should I say that, throw the baby with the bathwater. Countries like Netherlands, Ireland, Switzerland, they play an important role of business facilitation. So that's the nuance, I would say. Now, moving upwards about the linkages, yes, you are absolutely right, shown that the digitalization really get asset light, so there's less investment. Particularly the linkages of domestic firms in services aspect. The local suppliers may have less opportunities because of the distance servicing. But in the meantime, we also need to see that digitalization in developing countries create 3 types of investment opportunities. One is infrastructure, of course. The other is kind of linking to the global value chain. The third one is local contents. Local contents, digital local contents creation. Multinationals do not have the local knowledge, local skills, including culture and language. Updating, producing the creative products is for the locals. That linkage is there, and that hasn't been explored effectively by developing countries at large. So that local content development, linking to the global value chain with multinationals is a big potential. So it's a kind of on balance, there is an opportunity for further linkages that hasn't been explored. Let's trade intermediate goods. Yes, 3D printing, additive manufacturing takes time, but there are other factors that will reduce the intermediate goods. Just typical example of auto industry, the combustion engine moving parts that requires 2,000 such a moving parts, and for thousands of suppliers to produce that. Electrical cars, the battery moving parts, only 20. Reduction from 2,000 to 20. You can see how many supplier producers, the spare parts producers are going to be out of the job, out of the business. That is the situation that will reduce the intermediary trade. By how much? It's a huge amount. Just give you example, there are many other similar factors. So I'm saying that for multinational companies, the business model from global to multi-domestic, that is the term used by Porter before, that's the multi-domestic will be more in fashion. Pharmaceutical industry by nature is spoken hub, and the Nestle is in nature not a global company, but a multi-domestic company, so to speak. Food and beverage is not GVC intensive on global nature like auto. So there are different things. I leave the other 5 questions to Simon.
Let's give Simon a chance to answer some of these, because yes, we have gotten quite a number of questions in the chat, and I do see Alan's and Louis' hand up. So Simon, very quickly, and hopefully you can answer to also edit question in the chat that was directed to you as well.
Thank you. So I'll keep this brief. With respect to the returns in health and education, an argument which was made to me by one of our reviewers was that these are often heavily subsidized, and that maybe foreign firms find it, and by the way, domestic firms, private sector firms find it hard to compete against state-provided services at low price, low cost. So that may well be part of it. But then of course, that begs the question whether or not we should be subsidizing FDI or indeed domestic investment, private sector investment in these areas. Second, Sean, with respect to the current chapter 7 of our report, we actually track the number of such changes. And over time, there are more reforms than there are restrictions. But when we then went and said, okay, how much FDI is covered by these different policy changes, it flips, and it turns out that there's a larger share you compare figures 1 quarter on the arguments which were used for it, especially as they related to fire sale FDI. So I'm quite skeptical there. Last point on corporate tax reform. We use this US FDI database to look at what's the share of US profits, US multinational profits, which go to the 4 big tax havens, and the percentage of profits which are declared in the 4 big tax havens has risen 7 percentage points from 2000 to 2018. So there does seem to be some concentration in those 4 tax havens, and that also comes out when we tried to estimate whether or not there was anything unusual about the returns in places like Bermuda and Switzerland and places like this. So, and you do find that in the data. So there probably is a bit of an effect there, and it probably does distort some of the data. I think the interesting question is whether it's large enough to account for the downward trend in the returns on FDI. What is certainly the case is that the shifting of profits into tax havens can't really explain the rise in FDI returns on FDI from 2000 to 2009. So I still think there's probably other factors going on, plausibly. Let me stop there.
Thank you very much, Simon. Alan, please go ahead.
Thank you to both James and Simon for really a great couple of presentations, and for Sean's questions and observations. Just a quick question, which is prognosis. Can't extrapolate everything necessarily, but with respect to global value chains and FDI flows, hope for the future. Presumably, there are forces you've outlined work in different directions. What's dominant? What makes a difference? Thanks.
Thank you very much, Alan. And Lo, can I come to you to add your question to and comment to that?
Yeah, no, I have a quick comment, actually information to share, and also a quick question. No, the thing is that, I mean, our group and also most of us are policy guys. So the excellent presentations and also the good comments by Sean pointed out to really a very daunting situation about FDI and also GVCs, so on and so forth, also as related to the SDGs. So the question on our minds, and also particularly on my mind, is always how do we, through international cooperation, could respond to those challenges and see how our policy, international policy alignment could help with that. So we have tried to get some of the participants in the WTO investment facilitation initiative to come and share their views, but unfortunately, because of WTO has a house meeting, so they couldn't. But what I heard from them, just basically to share with you, is that first that they have a clear roadmap from now on to MC12 and beyond MC12. So they are very hopeful that they will conclude the 98%, let's say, of the issues on the negotiation by MC12. And then at MC12, the ministers are going to lay down, I mean, ministers of the participants are going to lay down a roadmap actually beyond MC12. So they're not going to resolve for the rest 2% by MC12, but beyond MC12 all the way maybe to summer next year, and to really conclude everything and announce it and begin to implement it. But the thing from some of the draft texts and also issues on the discussion, we could see that this is more very much, as the title goes, the investment facilitation, a kind of soft law kind of thing, which of course will not respond to many things we are on the discussion here, including investment protectionism, investment screening, and all these things, and barriers to services and others. So my question to you and also other participants here is that looking beyond probably even this trade investment in facilitation potential agreement, how could the WTO respond in different ways, probably not only rulemaking, but also existing channels, how to discuss and then find possible solutions to this. So thank you. Yeah.
Okay, I do have a very concrete question for Simon to add to from the chat. And Simon, this is with respect to your comment on services sector and your finding that the policy reactions to the FDI in the services sectors are even more adverse than in the goods. Yet it is said here that 2/3 of the FDI goes to the services sector. So can you unpack a little bit more your finding in that context of a dominance of FDI going to the service sector as well? So maybe we should have a comment on Alan's or response to Alan's question and to what Laurie was saying as well. Simon, do you want to start, and then we go back to James?
Okay, I'll try. If we think about the trends which we showed in our report, I mean, they've been set in for about 10 years now in terms of falling FDI inflows, or at least FDI inflows falling behind the growth of world GDP. And one would have to expect, you'd have to ask, why would that turn around? And here, I'd like to take us back to, I think, some of Sean's initial comments, which is, I think we're really on target, which is, we have to ask, what is the demand for FDI in emerging markets? And again, we should not necessarily put for FDI on a pedestal, because it's just one of many ways in which markets can be supplied from abroad. And that may be transforming dramatically because of digital delivery of services and the like, and the sort of advanced manufacturing. So maybe that, maybe in light of those technological and business developments, we should expect less FDI in the future, if those, to the extent that those things come to fruition or develop further. So it may be that the demand for FDI is shifting in a profound way, in which case we may see less of it in the future, I think, if one draws out those trends. With respect to Lou's question about how can international cooperation help, I mean, I think you somewhat answered your own question here, which is that it would be great if if the WTO we started talking a bit more about access to markets in respect to investment, but there does not appear to be much appetite for that at the moment, especially as it relates to the service sectors. But maybe one thing where the WTO can help is, of course, countries do have these trade policy reviews, and perhaps given that so many policies bear upon the profitability of FDI, the coherence of the policies in a country at any one point in time could be studied, because one gets the sense, certainly looking through the data that we have, that you probably have lots of different decision makers deciding different elements of this, and also at the national and subnational levels often within countries. And the overall policy mix might not be that coherent, and maybe documenting that and then discussing this in a trade policy review might be a useful role that the WTO could play there. Now, the last point which was put to me on the service sector FDI, it's true that there is quite a lot of service sector FDI, and it may well be, to the extent that entry is limited into the service sector, that there are rents or higher levels of profits which are associated with that. So it might be that policy is restrictive. It does create rents or profits, and the firms which are lucky enough to get in can benefit from them. And of course, then I think we would all ask the question, if we had freer entry into the service sector, could we deliver more benefits to buyers and to downstream users of those services too? So I think, again, I think I'd need to look more into this, but there could well be a story here of barrier jumping FDI. Thank you.
Thanks, thanks, Simon. And James, your comments on or your views on Aaron's and Lou's.
Thank you, Mia. I think Simon has answered the question. I just wish, in that case, to pick up what Lou has mentioned, this soft approach. In my article that I elaborate what do I mean by soft approach in multilateral investment policy making. Drawing the lessons learned from the past 5 decades of multilateral approach that all failed one with another. For that we have done some kind of, we have some experience experimenting over the past decade. In fact, our approach is to look at the entry point, start with the guiding principles. The guiding principles as a soft kind of instrument to guide countries is non-binding. We start in 2010 to draft such guiding principles and deliver the kind of policy framework for sustainable development. And through that, we try to disseminate to different countries. First, we tried with G20. 2016, we helped the G20 to draft the 10 guiding principles for global investment policy making. This is G20 guiding principles for global investment policy making, and was agreed among G20. It was kind of a milestone, but that's based on our UNCTAD 10 guiding principles. And later on, we also had a kind of agreement, reached consensus with ACP countries. That's a large group of countries. Countries agree to use that as a kind of basis for formulating, reforming their domestic laws and regulations, and in negotiating collectively of investment agreements with outside and among themselves. And later on, we also have introduced it to African Continental Free Trade Agreement. So that's some essence are in that. And then this is Islamic organization, what do we call it? Organization of Islamic Countries, ICO. Among these countries, they also adopted guiding principles for investment policy making, which is based on our principles. And now there are a number of regional groupings we approach to trying to set this consensus on guiding principles. It's a balanced approach of investment liberalization, facilitation, promotion on the one hand, and sustainable development goal-oriented on the other hand. So that's kind of a balanced approach. That's what I call the soft approach. First step. Second step, to build up technical systems programs, helping countries modernize their investment laws and regulations and reformulate their model treaty, the models for their investment treaties, and through there they negotiate. So that try to reform them, and then that reached out to over 100 countries, and for that even EU benefit from that. So they recognized clearly, and you can see the European Parliament resolutions recognizing these things, and the technical system on ground. So what is the rulemaking for investment? Be it at the multilateral level, at the regional level. At the end of the day, is to translate principles into policy practices. This can be done through negotiations. This can also be done through a kind of best endeavor among the stakeholders. It's right, not only the negotiators, but also the investment development stakeholders are all participated in, and we see what would be the best we can have, and then make it non-binding and adapt and adopted by countries with the support of international organizations. And then this becomes the policy practices on the ground, and the improved investment climate. That's the end, or that's the goal for attracting investment for sustainable development. That's what I call soft approach. And that has been successful as far as I see it. And I can give you plenty of evidence what has been done, including in the investment facilitation area. We had action plan for investment facilitation, and we built the technical cooperation programs, including the kind of a software installation for business facilitation, e-government, e-registration, and e-tax. And for that, you get investment climate improved significantly. This is what I call the soft approach. Investment facilitation is part of investment regime. So for WTO to be successful, it's not just to conclude the negotiations of the investment facilitation agreement. It has to be integrated in the global or the regional or the national investment policy framework, because investment facilitation is one wheel of the wheels of the car. You can cover it out, have it, but you cannot carry it alone. It doesn't take you 1 mile away from that.
Thank you, James. I have been given permission to go a few minutes over the time because there's still question or hands raised. Holim, do you want to
yes
come in with your question?
Yes, thanks very much, Mia. Thanks everyone. Good to see you all. Thanks for the excellent presentations, which I'm still trying to digest. I'm just two very basic questions, really. I mean, James, you made a comment, I think, about the great rise in sustainable finance and how this was moving very quickly, as well as the different ways of looking at the integration of environment and sustainability issues into FDI. I'm just wondering how does that relate to trade? I mean, what's the relationship between sustainable finance and trade? Maybe there isn't one, or maybe there should be one. Just a very broad question. And then another one which comes up is that there's a lot of demand, particularly from the developed countries, and it's not a new story, but I think is even more intense today, about integrating or bringing human rights, labor standards, climate-related standards, environmental governance, whichever way you want to put it, more directly into trade agreements. I guess this pressure is also there for investment agreements. And how do we address this? Particularly in light of what you already said, the continued decline of FDI. And it would seem to be a really big factor but it is not obvious to me how do we grapple with it. So if there are any thoughts on this, I'd be most grateful.
You want me to
please
get
go
in
ahead.
there?
I think both of you can comment on that. Shall we start with James?
Okay, thanks, Mia. Well, these two questions are really hard questions, and it begs a lot of research and the thinking, forward-looking thinking. The second question first. Now, indeed, the human rights, labor, environment, all these we call this ESG-related issues kick in and getting into the investment treaty negotiations, facing in. I would say these are the norms and the standards that integrate into investment rulemaking. It becomes a kind of mainstreaming now. It's mainstreaming. Starting already 2012, I would cut it off starting 2012 as the new generation of investment policy making. So there are two approaches addressing them. One is proactive, the other is promoting approach. The other is more of safeguarding approach. Safeguarding approach is more happening with the protection model of the investment treaties, bilateral investment treaties for promotion protection. It's not the liberalization treaties, so those market access treaties. That type of investment treaties that they introduced carve-outs, seeing that for all these binding, all these principles, M&A, MFN, NT, and fair and equitable treatment, FET, for all these standards and disciplines, and there's a carve-out. If governments introducing new policy measures related to environmental, human, government, and all these new standards coming in, and they will not subject to investor-state disputes. So that's the kind of more of defensive way that's happening for renegotiation of bilateral investment treaties and conclusion of new bilateral investment treaties. Now at regional, particularly at this mega regional treaties, and these are the kind of higher standards introduced starting with which are not in place yet, but all these mega ones do have, particularly the ACTPP and TTIP. TTIP is not there, but the contents are really having these high standards, while the RCEP hasn't touched upon that issue yet. These are what I would call it horizontal issues, because it cuts across not only investment but also trade. And then there's a template of this China EU one. That's the most recent one. Also deal with these issues in a kind of a lower level way, still not yet to the other bigger ones. But I think that's the trend. That's the trends, and they will be in. This is all going through the mainstream, what we call mainstream sustainable development. And this is what I call the mega trends of sustainability imperative. The current global economic relationship really has this paradox. On the one hand, there's a kind of deglobalization, regionalization. And on the other hand, there's a sustainability imperative that calls for multilateral collaboration. So, and there's intensification of collaboration, multilateral collaboration in the sustainability field, but there's a fragmentation further moving away from multilateralism in the hardcore rulemaking. So this is a kind of a very difficult kind of dilemma. I think that gets the policy making in a kind of disjuncted, a lot of inconsistency created because of that. Now the first question is about this abundant. For the time being, we haven't really looked into this, how we can benefit from all these sustainability themed funds for trade. At this stage, what we are looking into is that how we can translate all these funds that's available in trillions to channel into the sustainable development sectors in developing countries. At this stage, we know that 98% of these funds remain in the north and invest mainly, the big chunk is in renewables, but it hasn't been crossed equator to the south landed on the sustainable development field. That's what we're trying to do, the channeling. And that comes to the issue Sean raised earlier, the demand side. There's a kind of constraint of bankable pipeline projects. There's a lack of bankable pipeline projects to get it ready for investment. That's the capacity in developing countries. There's also kind of a problem of liberalization. So I think Simon mentioned about this liberalization in services. In fact, it's more of public services. If you look at SDG sectors are the most closed sectors compared with manufacturing and extractive industry. So most of the SDG sectors are not fully liberalized for private sector, including foreign investment. That's what I found. That's what we have found out, and looking into the regulatory frameworks of countries. But they have a reason for that, because countries they have a legitimate right to ensure goods and services that provided are accessible and affordable by the population at large. And for that, the government plays a role. So that's why in the past, they want the public sector, state-owned, to play a role. Now it's not sustainable for private one to get in. They still need to balance the liberalization with the regulation. And that's very challenging for them. And the risk-return profile for those sectors, investment in these sectors, is very low, like not attractive. That's why incentive kicks in. Simon mentioned that too. Investment is critical, but when you get the tax kick in, that has an impact on investment, on incentives investment, particularly for SDGs. So how to handle that issue is a challenge. That begs to Sean's question, how to handle the tax issue. This is one of the issues. Investment incentives for sustainable development sector investment. And that how to deal with the tax aspect.
Thank you, James. And Simon, I think some of the things that James was last saying go to the issues that you found about low returns in those sustainable development sectors, being linked also low risks given the state's involvement, right? But please go ahead and give us your views on those two tough questions by Holim.
So I'm just going to speak to the second question by Holim, because I think it's a very important development. We're seeing a lot of it in Europe, that governments and civil society are demanding the firms operating supply chains comply with more and more standards. And indeed, I think this has put pressure on a lot of companies. I think the implicit assumption of many of the people making those demands is that big business can absorb the additional costs of doing this. I hope to have shown in our work that that assumption might not be correct, in which case, if firms are going to take on these additional costs and burdens, then the question will arise whether they can pass those on in terms of higher prices to European consumers and alike. And I think this is a part of the equation which is not explicitly discussed. I should say that yesterday I was in a webinar with a European Union or Commission official who actually went so far as to say that as far as she was concerned, access to the European market for firms operating supply chains should be conditional on operating supply chains with European values. And it's almost as if the sort of trade and environment, trade and labor agenda, which has not been very successfully incorporated into trade agreements or because of developing country opposition, it seems like the pressure is building to essentially advance that agenda, but through pressure on firms that operate cross-border supply chains. And so I think if that is what's going on, then I think we should have a broader discussion at the WTO and elsewhere as to what constitutes legitimate public policy in this regard. Now, none of that is to suggest or to endorse business misconduct, and businesses operating across borders must comply with national laws and alike. But I think what is being proposed here in Europe often, and has been, I believe, codified in German law, goes well beyond that. And I think we should have a serious discussion about, again, whether or not we are expecting too much from international business. And I think we should also ask the question, why is it that international business keeps being asked to fix all these problems, and why are states not being asked to do this? Yep, I'll stop there.
Thank you so much, Simon, for adding yet more questions to the list that we started with 32 plus 10 plus some of added on this. I have abused the benevolence of the organizer and participants, and we have really went over the time for quite a bit. So let me kindly ask participants if they still have some questions to reserve them and to perhaps pose them directly to the speakers, because we all know each other. I'm not going to attempt to summarize this discussion. I would want to say a few things, but also to perhaps invite sequel to this, because obviously there are so many issues that we haven't even started talking about. And one of these, thank you, Holim, for opening the door through by mentioning the RTAs in particular and all of these issues. But I think what we are experiencing, at least from the Asian perspective that I was exposed to, is really this changing view and the perspective on the role of foreign direct investment and trade in development. And so what we are looking at really is much more of the inward reliance or inward development strategy reliance, to the extent that openly some of the countries would say that foreign direct investment are not welcome, and should be the reliance on those should be minimized. And this, of course, has been sort of augmented by the panicky views through the pandemic, but it has existed before, and it's a lingering process, and we need to be looking at why is that so. And it goes back, and I'm sorry that I have to bring this UN-ish sort of perspectives, but it goes back to really on the benefits of the way of development and inequalities and deepening of inequalities, particularly in those countries that had enjoyed lots of FDIs. And so the way to proceed and to deal with that is really to see how we can change the course in that, and how we can actually balance the benefits in the countries that do depend on FDI in a slightly better way, so that the impression is not that all the profits are actually going away with the foreign investors and not staying with the workers and with the country inside. And of course, part of that has been discussed also in the context of the incentives that are given and how they are given, and whether they are given in a transparent and accountable way, or are they actually also slotted or biased in terms of providing certain benefits to the vested interest in those countries. But I'm just mentioning these because these are part of the discussions that are still prevailing in some of the particularly developing countries in Asia. And of course, now we are facing all of these very geopolitical sort of positioning in terms of foreign direct investment also being really packaged as seeking advantages in security, national security, and military context, and preventing actually the parts of the foreign direct investment that was previously linked to is the sort of transfer of knowledge and transfer of technology. By painting all of these cross-border transactions as having national security issues, we are actually preventing for these benefits to be had as well. So I think there are so many other issues that still have to be looked at, including with changing of business models and looking, more and more businesses have at least part of their operations that are focused on impact investment and are not really seeking the highest returns, but are trying to actually go after also doing good while doing well for themselves. So all of these taken into account may provide some explanations of why do we have this long-term trend in falling of FDI. But there are unanswered questions, particularly with respect to, are there differences between multinational companies, American ones? We have discovered that their returns are not as high in non-manufacturing sectors as we would have expected, given the risk in emerging markets. But the question may be also about how the profit shifting or their financial governance has been affecting these, and whether we actually do have a proper picture about that, and what about other multinational enterprises? Do they experience the same thing? And the big question for me in all of this is what is the standing of, for example, Chinese investors, and are they driven by different factors than those in advanced countries? So I have personally lots of questions still, and I hope we can continue our discussions to be able to provide more evidence in these discussions, so that we can formulate better policies. So I'm really thankful to James, Simon, and Sean for giving us so much food for thought, and I hope to see you all in the next event, and I think Lo will tell us when that event will be happening and what it will be. So back to you, Lo.
Yeah, thank you very much, Mia. And also thanks go to Simon, James, and also Sean, and also other participants. This is really a great discussion. And as you say, that there are many things that we need more time and need more evidence to further our discussion, and hopefully in the near future. For our group, that we all have 2 sessions planned before summer break. So on July 8th, we are going to have a session on WTO agriculture negotiations, and the invitations have already been sent to you all, and we will send also further to some other stakeholders, as we said. And then the week after, we are going to have a ebook launch initiative, a ebook recently done by the leadership of Bernard Hoekman of EUI in Florence, and also Professor Tu, whom you know from China UIBE. And then many of our group members have participated, covering a whole list of hot issues on WTO reform, including special and differential treatment subsidies, SOEs, many others. So we are planning for these two, and you will receive invitations, and I do look forward to see you all then. And so thanks again to all the participants and all the speakers. And I wish you a very nice weekend, and particularly to Mia, wish you a good sleep or the rest of the sleep, and also a peaceful rest of your quarantine, and you will join your family in New Zealand very soon. Okay, with that, I thank you all for your participation. See you soon. Thank you.